Hi folks, Steve.ryan here from Stephen Accounting. So you're starting your own business? That's pretty cool. Thought I'd do a few quick videos on the most common questions and situations that come up. I live and breathe this stuff, but I'm only going to be scratching the surface. So if you want to know more, leave a comment, send me an email, I'll get back to you. Today's video is on cars. When you use a car for your business, you're allowed to claim the business portion of the running costs. The fuel, the maintenance, WAF, insurance, all of that. If the car is purely business use, then it's easy. You can claim 100%. But most small business owners drive their car for a mix of business and personal trips. So, how much are you allowed to claim? Well, there's three different methods you can use. There's the actual cost method, the 25% rule, and the logbook method. For the actual cost method, you keep a logbook for 3 months, tracking the distance you travel for personal versus business use. This gives you a percent of vehicle expenses that you can claim as a business owner, which you can use for 3 years. You pay for everything out of the business account and then make an adjustment at the end of the year to take out your private use. This method is best if you use your car regularly and you want to limit your admin to 3 months of keeping a logbook and an end of year adjustment. For the 25% rule, you can just claim up to 25% of the car's outgoing costs without needing to do a logbook. This method's the least amount of work, and it's perfect if you're using the car for approximately 25% or less business travel. If you choose an amount that seems unreasonable, then you might get asked to justify it. For the logbook method, you keep a track of the distance of every business trip that you do. Then, at the end of the year, you use an IRD published kilometre rate to calculate your deduction. This method is best if you're not making very many business trips. Inland Revenue has a great little spreadsheet that you can use for your logbook, which you can find by clicking on one of the links in the description below. One common mistake is not understanding what's personal versus business. For example, driving to and from the same workplace every day is personal travel, but driving to different places of work is business. So, if you're heading to the same office day after day, that's private, but heading to a different work site every day would be business. A practical way to think about this is if it was one of your employees making that trip using their own car, would you reimburse them for the mileage? If you would, it's business, and if you wouldn't, it's personal. Another common mistake is not understanding how depreciation works. A very common rookie mistake is for a business owner to look over the books in February, see that they're having a great year and think, I need to get my tax down, so I'm going to buy the company a new truck. For capital expenditure, like a new truck, you don't claim the full expense when you buy it. You depreciate the asset over its useful life. So, say that you were going to buy a light truck for $25,000 in February. You'd be forgiven for thinking that you can claim for $25,000 that year. But that $25,000 is spread over the useful life of the truck starting from February. That means if you've got a March balance date, you'd only get 2 months worth of deductions for that tax year, which comes out to be about $438. What about fringe benefit tax? If your company makes a vehicle available to employees to use privately, then you might be liable for fringe benefit tax. That does include you if you use a company car privately. There are exemptions for work-related vehicles, emergency calls and business travel, but there's a few hoops you have to jump through to qualify for these exemptions. I've linked where you can dive deeper in the description below. If you've got a vehicle tax question, just leave a comment, send me an email, and I'll get back to you.